everyone. Good evening. Today is April 12th. Welcome to our weekly update from Charts Are Fun. This is Rohan Singh and Abhijit Chatterjee. Pointing you again to our blog site at chartsarefun.substack.com. Quite a few interesting blogs were posted this week, starting with an interesting blog about Boeing. We know that it's been in the news a lot in the last couple of months, ever since the Alaska airline fiasco that happened in flight from Portland to Ontario, California in kind of early January. The stock has been very volatile. So there was a blog on that, talked about PLT, then the PPI and CPI, that what happened this week, and then finally Bitcoin this evening. So basically, today's session will have a quick overview of the market. From there, we will talk a little bit about QQQ in terms of what that did. We know that it's a barometer we've been following. It's been weakening recently till this week when it suddenly outperformed. Then from there, we'll also touch on silver, an interesting play on silver. It met its target today, and then how one could have played it through a short ETF on silver. And then finally, a big week is coming up with the crypto halving event, the Bitcoin halving event next week. It's expected to be on April 20th. And we'll visit the crypto market, the Bitcoin market, and the stocks. So with that, without further ado, let's start off with the blog site. I just talked about some of the blogs that were published today, and also point you to our YouTube site, Charts Are Fun. That's our channel, at Charts Are Fun. We really welcome you to subscribe, and also, if you like our videos, to hit the like button. So this again helps us to share this with a broader audience. So let's start off with the market comparisons. Here, we do it every week. We're looking at 8th is the Monday of this week till 12th. And we're looking at some of the core ETFs. ETFs such as, SLV, silver, UVP for dollar, GLD for gold, the NASDAQ 100, QQQ, for Bitcoin, the most popular ETF, the Grayscale Bitcoin ETF, GBTC, long-term Treasury, ETF TLT, S&P 500, SPY, the emerging market EM, Diamond, the DIA for Dow Jones, the 30 index, and small caps, IWM, the Russell 2000. So what happened this week is, in fact, 3 of these ETFs actually were positive for the week. The strongest was silver, shown in black. It was about 2.5% for the week. And it stayed strong throughout the week. If you look at silver and you look at the movement right from, this is 5th of April was last Friday, but right from Monday 8th, it stayed up towards the top of the group, and it kind of maintained that lead. For initially, the Grayscale Bitcoin ETF did kind of have a very strong upswing on Monday. In fact, was almost holding up at 6.5% on Monday, but gave up all those gains through the week, coming down to closing close to minus 0.73% for the week. So silver was the strongest. Dollar had an amazingly strong week. The UUP, the dollar ETF, is up 1.76%. Dollar tends to be a beneficiary of the treasuries. So when you have yields on treasuries shoot up, and we're going to talk a little bit about the TNX, the treasury 10-year treasury chart as well. So TNX did break above a key resistance level at 4.35% and touched 4.5% this week, and that did help the US dollar. And then the third positive ETF this week was gold. So silver and gold, both are precious metals, and gold closed up 0.81%. Everything else was down for the week. The worst performer was small caps, down 2.82%. The one right above that was Diamond, the Dow Jones ETF. Then emerging market right above that at 1.75, S&P 500 at 1.46. If we look at the core 4 index-based ETFs, the IWM, DIA, SPY, and QQQ, QQQ actually outperformed this week, and it was only down minus 0.5%. So we know Apple had a good upswing recently, and that kind of helped QQQ, but the Magnificent Seven stocks in general, in fact, even Tesla, that had been underperforming quite a bit in January and February and March, came up quite a bit in the last few days. In fact, the big excitement of Tesla was the their robo service that the Tesla company wants to provide so that you could have autonomous taxis and autonomous kind of cars out there. That's expected to launch this year. People were expecting a date from Musk, and Musk announced that by the August timeframe, he plans to launch that service. So that actually helped Tesla get quite a bit of upswing in the last few days. And Magnificent Seven in general, Google has been hovering towards its highs, Amazon towards its highs, and so on. They've also done quite well. And NVIDIA also got a bid, kind of managed to go over 900 recently. So that's the market looking at the core ETFs. And then we always look at the sectors. These are the 11 sectors. And we typically leave the real estate sector out, which actually took a beating this week. The real estate sector took a beating in particular because of higher interest rates. Higher interest rates are not good for the home builders and for the real estate sector in general. And because 10-year yield and 30-year yields in general for the treasuries went up because of hot CPI data, expectation of Fed rates cuts that actually went down. And I'm going to talk shortly about that as well. There is a CME FedWatch tool that tells us about the expectations for rate cuts, and we'll show you where the current probability stands for the June cuts. So if you look at the weekly performance of the sectors, all of them, in this case, leaving the real estate was also negative, but all the remaining 10 that we're looking at were negative. The strongest was actually technology, XLK. That was only down minus 0.5%, kind of gelling with QQQ outperforming. QQQ outperforming means QQQ is a technology-heavy ETF. That outperform means XLK outperformed, and both kind of closed about 0.5% down for the week. But the worst was financials. Today, we got a big beating from JP Morgan, Citigroup, and Wells Fargo. Their earnings came out, and the banks got hit hard. And so that was the worst performer, down minus 3.6%. The materials, even the gold and silver did well. The rest of the materials, the basic materials, whether it's copper, whether it's aluminum and others, actually took a dip, so it was down 3%. The healthcare XLV was also down 3%. Industrials down 2.2%, and the discretionary, which happens to be Amazon's and then the Teslas, actually did reasonably okay, down just about little above minus 0.1% at minus 0.97%. So if you can see that everything is below the zero line, all the 10 sectors, and overall, though some did end up positive till Thursday, but come in today, the market pulled back, and all of them ended up pulling negative for the week. So in fact, the top three in here, technology, discretionary, and the green one being communications, were actually holding positive till Thursday. And then today on Friday, they all came down, and the entire 10 sectors were down negative. So with that, what exactly happened in terms of core news this week? Well, one thing for sure, we know that the CPI release came out, and CPI actually turned out to be hotter than expected. So there is two parts to the CPI. If you look at the headline CPI, which includes energy and food, that rose 3.5%. But if you take core CPI, taking food and energy, which tend to be volatile components out, it was even higher at 3.8%. Food rose 0.3, energy rose 0.2. Core goods fell 0.2, and core services, that continues to be strong. A lot of auto, insurance prices have been going up. That kind of shot the CPI prices higher, and that market did not like. It's the continued fear of inflation. So now for 3 successive months, January, February, and March, inflationary data has been trending higher, and that's not what the market likes in terms of Fed not being as eager to cut rates if the inflation remains strong. PPI, the producer price index or the wholesale price index, also rose, but not as strong as the CPI. CPI was released on Wednesday, and hence it took the market quite a bit of hit on Wednesday. Thursday, PPI was tamer, so the market did get a bit of a bid on Thursday. But then going into Friday after the bank earnings, we are now into full-blown earnings season starting next week. The market is now a bit jittery about earnings, and as a result, sold off today. Now, the other thing that is worth watching is today's bank results came out. So that's kind of typically banks are the first to announce in the earnings season from an S&P 500. Their earnings typically happen on a Friday of the first couple of weeks of the quarter. So in this case, today was April 12th, and all the three big banks, JP Morgan, the biggest bank, Citigroup, Wells Fargo, all had earnings. And as we can see that the earnings were actually beat, some of the expectations of the market. However, market did not like their concerns with the higher interest rates, their loans, their the still continued fear with the commercial real estate, and overall inflationary jitters took over and the banks got hit. So we noticed that Jamie Dimon continues to be cautious. He's the CEO of JP Morgan, and he still says that a bad economy is actually quite higher probability than people think. And he's been worried about the continued debt that the country continues to have, the deficit spending, and overall concerns with the fundamentals of even household debt shooting higher, and overall concerns of inflation to him. In fact, he feels that rates could be as high as 8% at the way inflation keeps staying strong. So the tool that I talked about that does track the Fed is called the CME Group's Market Watch tool. It's called the FedWatch tool. It's right here. It's the CME FedWatch tool, cmegroup.com. And if you look at it in here, you can click on May. In May, you can notice that pretty much 98% the market's probability is the rate remain at where it is currently between 5.2 to 5.5%. So that's the expected rate for May. So 98% people or probability is that there's no rate cut. Going into June, it actually went up slightly today to 27% chance of a 25 basis point rate cut. It had fallen as low as 17% on Wednesday after the hot CPI data. So the PPI being a bit tamer on Thursday did help take this number from 17 up to 27. But still, we're looking at almost 72% probability of no rate cuts in June and about remaining 27 or 28% of a rate cut. And this is actually very small probability of two rate cuts, as in 225 basis, as in a 50 basis point rate cut, a 0.5% rate cut is a very small fraction of the people expect that. Going from there into July, if you look at the July Fed meeting, people expect almost 45 plus 11. That's almost more than half of the folks, as in 56%, almost 57% expectation for a rate cut, 25 basis points or more into July, and 43% probability of no rate cut. So there we do see that from July onwards, there is expectations. For now, overall number of rate cuts is expected to be about 2 cuts this year. It had gone as high as even 6 during the December timeframe. So as inflation continues to be stubbornly high and trending higher from January to February to March, expectations for the market now is that it's possible that the rate cuts will come down and we will potentially only get maybe 2 cuts. Now, an interesting barometer of rate cuts or rate expectations, and also a barometer of risk taking from the market in terms of risk on, risk off. And in fact, a very interesting term got coined on CNBC. If you watch a guy called Josh Brown, he's a commentator there. He's coined this idea of cut on, cut off. Cut on as in the market's expectation of rate cut being on, and cut off is market expects the expectation of rate cut is not as high as the market does not expect a rate cut. So the cut on, cut off market has been causing this volatility. And in particular, the TNX, the 10-year yield chart, shows a beautiful ascending triangle. Ascending triangle, why? Because if you look at the resistance level at 43.5 is 4.35. So divide that by 10. So 4.35 is the resistance. We noticed that it hit it multiple times and pulled back. And very recently, which is this Wednesday after the CPI data came out, we got a bullish breakout above the 4.35 all the way. And we touched close to 4.59 or 4.6% yesterday, and then pulled back today a little bit back below 4.5%. And 44.99 is 4.49%. So that ascending triangle actually measures to a target above 4.9%. How? If you take the 43.5 and you take the bottom 37.85, that's roughly, you're talking about like 38 to 43 is 5.5. So 5.5 added to 43.5 is close to 449 plus. So 49 plus is 4.9%. So the 10-year yield, if this breakout and technical pattern pans out, could rise as high as 4.9%. And you notice this part when that happened from September to late October, when it rose from 4% to 4.9%, the market did not like it. The market did pull back during the time frame. So if this trend of higher yields continues, there's a good chance that we might get a market pullback. So how do we measure that expectation for the market pullback? So let's look at the QQQ chart. QQQ chart, remember, did pull back. So from 378 pull back to 341 during that time frame from September to late October, right? When I was talking about the 10-year yield during that time went from 4% to 4.99% or 4.95%. In a similar way, we can expect if the 10-year yield continues to climb higher, this dome-shaped top forming in QQQ. How do you get the dome? We join as it climbs to higher highs. So we take those highs and we join them. We see a parabolic dome forming. And a parabolic dome forming with a negative divergence where the RSIs are printing lower highs and a negative divergence in MACD with the RSIs printing lower highs is actually a bearish sign. So we are noticing that it's kind of not being able to cross above the resistance level that the dome is printing out. So this week, even though we got a little bit of rally after the 10 PPI yesterday, and QQQ came back up towards 430, 443, 444, but it did not break out. It kind of got rejected at the intersection of the dome. So that again is a bearish pattern, something to watch for. And this kind of slopes downwards, which means gradually we could see QQQ trending lower over the next several weeks as the 10-year yield keeps climbing towards the 4.9% if that pans out. The other thing to watch is the hourly chart. So we looked at the daily chart where the dome shape was popping up. This is the hourly chart. Every candle is an hour. Join the peaks, so 449, 447, 446, and 446. And as you join the peaks, it's a declining tops trend line. And notice that the market keeps getting rejected right there. It goes up there, gets rejected, goes up there, gets rejected. And yesterday, after the 10 PPI, it came close to breaking higher. It did break above the trend line, but could not manage to close the hour. So when a candle, leads a wick, that's an intra period move. During that hour, this is the entire hour, this is from 2 to 3 p.m. And then the last hour is 3 to 4 p.m. So 2 to 3 p.m., it tried to climb and break above that trend line, but didn't manage to close above it. It pulled back and the body of the candle closed below that. The same thing, the next hour from 3 to 4, it actually ended up with a negative candle. This is a very bearish candle. In many cases, it's a shooting star candle. So it kind of closed and ended about the same level. But intra period during that hour, it did go up to 446.33, but gave up those gains and pulled back towards the lows of the candle by end of the hour. So these two candles with a wick on the top are bearish looking candles. And no wonder opening into today with the bank earnings, we got a gap down and we trended lower throughout the morning into the afternoon. So from the 442 level where the market tried to climb back up, couldn't make it. So it opened actually closer to 441, went up to 442, didn't make it, and went as low as 436.88, which is slightly higher than the low from the CPI print on Wednesday, slightly higher than that. And then it kind of closed closer to 438. Couple of things if you're on the bullish side, looking at the QQQ for a short-term trade. What is interesting is it has lower highs so far, 435, 436.28. And today it had a chance to break lower below the 436.28. It did not. It held it, having a slightly higher low at 436.88. So if you had to look into a trading into early next week, Monday, Tuesday, it's a possibility that the market could perhaps catch a bid and again make another attempt to go to this declining trend line. And that's, of course, declining, so it will no longer be at 446. Moving into next week, it'll likely be towards 444, 443. So it's a possibility. And we see that the last hour of trading, we got a nice white candle and also the volume was relatively stronger for the entire day. So this is the 12th, which is today's trade. Every bar chart here is the volume for that hour of trading, and we see that the last hour it printed the strongest volume. So there was some buying, and you can see that in the AD line as well. The AD went up in the last hour. So there was some buying. And the other key thing to notice is the relative performance. When you take the ETF QQQ with a ratio of SPX, we noticed that starting from late March, from 26th onwards, it had been steadily declining, as in it underperformed, QQQ underperformed S&P 500. Then it kind of flatlined the first part of April. And this week, after the CPI print from the 10th, then it was the Wednesday, there was some buying after the initial drop. And then yesterday, after the PPI print, a lot of buying, and in fact, it went positive over S&P 500. The relative ratio went slightly positive. Today, it pulled back, but end of the day, it kind of reclaimed close to the zero line. So QQQ is making an attempt. Maybe what the market thinks is, look, interest rates may go higher. It may impact small caps. It may impact those that are non-profitable, those need to raise capital for cost of capital. But the Magnificent Seven, they're flush with cash. They're in very strong economic growth cycles. People are buying AI. People are buying, Microsoft's Copilot. People are buying NVIDIA's GPUs. People are buying all kinds of technology services and investing in the advertising dollars for the Googles and the Metas and so on. So market seems to be bullish overall. And also the WWDC, their Apple's developer event is coming up, and there's expectation that perhaps they'll have some bullish AI momentum coming out of that meeting as well. So overall, looks like technology may catch a bid next week. At least near term, it's trending lower, but it seems to be very strong fight for the bulls, and there's a possibility it might make another attempt to climb back towards the top of the trend line next week. Just looking at the way the volume ended in the last hour, with strong volume relative to the other candles, the other bar charts on the volume, kind of a white bullish candle in the last hour of trading, AD pointing higher, and the relative strength coming back towards the zero between the S&P 500 to the QQQ. That's something to look into. Now, talked about the precious metals having an amazing week. Well, today it had an interesting reversal as well. So the SLV, which is the ETF for silver, had a beautiful cup and handle from December through March. 23.37 is the left of the cup, 23.45 is the right of the cup. The bottom of the cup is 20.07. So 20.07 to 23.45, that's about 3.38. At 3.38 to 23.45, that takes us to 26.83. Beautifully, today, silver kind of opened up near 26.8, very close to the target of 26.83. It opened up right near there, 26.8. Intraday, it hit 27.2. And then because it had met its target, there was selling. It was selling across the board in everything. Silver was not left out. There was selling because profit taking kicked in. And look at the heavy volume when you had that kind of bearish candle. A bearish candle, why? Because it's a red-filled candle. It opened towards the highs of the day, but ended towards the lows of the day. That meant throughout the day, there was continuous selling going on, where the candle printed, the open is where the 26.8 level is, and the close is at 25.63. So significantly lower close from where it opened. And it was selling throughout the day with heavy volume. So that near term was actually bearish. And if you are looking into taking advantage of this, if you were anticipating this silver achieving its target near 27 and then having a pullback, one way to play it was this morning when that was going on, when silver was near 27 and testing that level. There is a short ETF to silver called ZSL. It's a pro short, ultra short silver, and it actually moves twice the silver. So if silver was down today, say minus 1.4%, ZSL will be actually a little more than double of that. So it was up 3.2%. So it's the reverse of silver. Silver goes higher, ZSL comes down, silver goes lower, ZSL goes up. So today, ZSL had an amazing move. So way to look at it this morning, it opened near 11.87. It went as low as 11.44 when silver SLV was above 27. So if you bought ZSL around 11.5, 11.6 this morning, when silver was at 27 plus, and you were looking to silver to pull back, having met its target. You could have bought the ZSL and look at the nice move it had from there, closing above 13 and with heavy volume. So that's a way sometimes when you're looking at ETF or looking at the stock and you're looking to play its reversal, having met its target, you can look at many of these stocks these days, even for NVIDIA, Apple, these big magnificent 7 stocks have their shorts as well. So you could look at the ETF that kind of corresponds to the short of that key stock or the key ETF, and then buy that to play a reversal in that particular ETF. Finally, I talked about the next part of the agenda, which is the last part of the agenda, into cryptos. So the halving event, which is the number of coins that a miner receives for mining a block of crypto. So for a mining every block, as of last 4 years, it has been 6.25 coins per block that's mined. That will get cut into half. So if you mine a block, you will no longer get 6.25. You'll get 3.125 coins starting next week after the April 20th. And that happens every 4 years. This was Satoshi-san who invented Bitcoin, put this in. This kind of controls the supply of Bitcoins. It kind of controls how you have the scarcity of this interesting asset, this crypto asset. It's also called the digital gold. And today, if you look at the comparison of how many Bitcoins are brought out into the market, mined into the market every year, it's about 1.8%, which will be cut into half to 0.9% of new cryptos will get coined or mined every year. And gold is mined at about 1.5% additional gold gets mined every year. So it's about similar level of scarcity in terms of supply that will come from the digital gold versus the real gold. So interesting enough, there's a flagpole. If you look at the highs of the BTC chart and you join as a trend line, so that's the flagpole from 38.5 as it climbed up to 73.8. And then if you take the tops over the last, since that 73.8K, the declining tops and the upper trending lows, that is what we call as a pennant shape. So a flagpole with a pennant usually has a breakout pattern to the upside. It's usually a bullish pattern, which means if we kind of get a breakout over the next week, there's a possibility that this could climb higher. Now, how high could it climb? Well, let's look at the weekly chart of crypto. The previous was the daily chart. The weekly chart of BTC, the crypto, shows an inverse head and shoulder. So we have the neckline around 48, 49K. The left shoulder here is at 34.3K. Then we have a head near 15.5 back to 49. So that's the big head that was formed. And then a short right shoulder from 49 to 38.5. So that breakout, if we take 49.1 to 15.5, measure that, you're talking about roughly 33.6K. At 33.6K to 49.1K, that's roughly 82.7K. So 83K if you round it up. So that's where this inverse head and shoulder measures. And having looked at the pennant shape and the breakout coming out of it, it would potentially get back. And if you take this rising trend line in the flagpole, that also over time extends to closer to the 82, the 83K. So that's the possibility of where crypto could be headed after the halving event. And that could mean that way to play it is either you could play it through the ETFs, and there are many ETFs such as Fidelity's is FBTC, Grayscale's is GBTC, and iShares. They all have various ETFs, and they have different cost structures. So in the blog that we posted today, take a look. There's a link in there to look at the various ETFs, their liquidity, and as in how many coins they have in their holding, how much of investors have already invested in that ETF, and also in terms of the cost structures, how much do they charge you for maintaining that ETF. So a key play to play this for, it's an expensive stock because it was almost as close to $2,000, 1999.99, lovely number where it topped out and then pulled back. It is also, it's MicroStrategy. It's actually a business intelligence company that makes software for BI, for reporting, for looking at visual analysis. That has got a beautiful pennant shape as well. It's also got a flagpole from 438 going to 1999. The declining tops and the rising bottoms form a pennant, and that breakout can measure almost close to $2,500. So it closed below 1,500 at 1,479. If you had that kind of money to buy, say 10 or 10 shares would cost you almost $14,000 on this MicroStrategy, but say you bought 100 shares, that would be quite a bit of money. You would have to have $150,000 roughly to trade on or to invest on MicroStrategy. But this is one way to play the Bitcoin breakout, is MicroStrategy will break out higher at the pennant just as BTC breaks higher. Another way to look at it is the miners. There are two key miners. There are many, but the two biggest ones are Mara and RIOT. And Mara actually, both the miners got cut in half. If you look at the late February peak at 34, it hit 16 today. Same thing with RIOT. RIOT's late February peak was close to 18. Today it hit $9. They both got cut in half. Why? Because if you think about their mining revenue, for every block that they're going to mine, for all the electricity cost, for all the infrastructure costs with the data centers that they buy and add these heavy-duty computers, they will their revenue, as in the reward that they will get for mining every block, is half. So no wonder if they're going to get half their revenue from mining the cryptos from the same cost, they're effectively going to get cut in half on their stock prices, because that's their revenue that they're going to get from. So their sales is going to get cut in half. However, the key things people forget is that's true. Their total number of coin mined every month or every quarter will cut in half. However, they have been investing. They've been adding new miners, new computers on their infrastructure. Also, the crypto price, if it goes higher for the same number of, for half the set of coins that they mined, if the price doubles, then their net revenue comes out to be the same as what it was before the halving event. So that's something to look into. Scarcity of the crypto, as you get fewer and fewer cryptos mined, will generate higher prices. There's possibility. And that's what happened over the last, this is the fourth halving. The last three halvings that have happened over the last 12 years have invariably caused a higher market trending after the halving event. So if that happens and the trend continues, then these miners, for fewer set of coins that they will mine, will catch up to the revenue because of the higher price per crypto that they mine. However, the other thing to keep in mind is they have been adding capacity. They have been acquiring other miners. They've been consolidating. So there's going to be some consolidation. Some miners may go out of business, so there might be a shrinkage of the number of miners, but the strong ones are expected to continue. Just like gold miners just don't die out, their profit margins may come down. So in this case, the profit margins of these may come down, but they're expected to catch up with the price of the crypto going higher, and their revenues may start growing again. So this must actually, you always remember the idea of buy low, sell high. It was not about chasing Mara when it is 34. It's about considering buying Mara now when it's pulled back or cut in half, when very few people, and in fact, look at the volume. It did pull back, but has there been active selling? Not really. There's just minimal volume in this pullback. So if any, these are absolute great times to look into buying miners such as Mara and RIOT. And if you look at relative performance as well, the AD has been bad. That is just overall not as much of buying going on. But if you look at Mara to SPX, it actually is positive. Over the last 7 months from September, it's actually relatively outperformed S&P 500 by 18%. And the same thing if you look at with the crypto, however, the BTC, it underperformed. It was over minus 48%. So it did not outperform the S&P. It outperformed S&P 500 by 18%, but from a BTC did a lot better. And that's no wonder, because it got cut in half. So obviously it is down minus 50% from the crypto's price. But the crypto price has been trending higher. The miners price, especially in the last couple of months from late February to mid-April now, it got cut in half. Finally, just to show you what happened on the banking, which we know that was big in the news today, banking earnings came out. But the reason I'm sharing this chart is a beautiful negative divergence stopping pattern. Why? Because as the JP Morgan has been climbing higher highs from 176 to 189 to 198 to 199, especially the last three consecutive high, 189, 198, 199, look at what happened to RSI. RSI kept getting weaker and weaker. That's a beautiful negative divergence and a classic forward-looking sign or a classic leading indicator of a market top. So this was a lower high in RSI and a higher high in price is how market tops happen. And look where we came down. One of the highest drops in JP Morgan since June of 2020. That's when it fell over 8%. Today it fell 6.5% with very heavy volume. So there was profit taking distribution in JP Morgan, and something that if you had looked at the negative divergence and you were a JP Morgan stockholder, you would have probably taken profits or sold some covered calls at maybe 199 or 200 strike, so that you would have recovered some of that as a premium as the price came lower as a hedge. So with that, thanks for sticking in and listening to the video. So the three things we covered was the market overview, the CPI and being hotter, PPI being tame. That overall did break the 10-year yields higher. 10-year yields breaking higher means the interest rate cut expectations went down. That caused the market to shake up. Pretty much across the board, markets got hit this week. Pretty much all sectors were negative for the week. And in particular, looking at QQQ, while it did fall, it relatively outperformed the S&P 500 and the small caps. Small caps are most interest rate sensitive. The Magnificent Seven, the big tech companies are not, because they don't have debt in their balance sheets. Their business fundamentals are still strong. So with earnings season coming up, market is bullish on those Magnificent Seven earnings, and hence QQQ expectations for earnings are good. We are into earnings season. We are into April. Next couple of weeks will be strong earnings of all these companies, and that's perhaps why QQQ has a possibility of trending slightly higher again if earnings gives them the momentum. With that, we talked about crypto. A big halving event is happening next week on the 20th, and something to look from the pennant shape, a possibility of a breakout. And if we do get the breakout, a way to play it is either through Coin, which is their biggest exchange through which the cryptos get traded. That chart actually has a pennant and a beautiful looking breakout pattern, or MicroStrategy, which is the BI company, but with a significant part of the balance sheet invested in Bitcoins. Or if you want to be a little bold and buy low, sell high, then look into the miners, RIOT or Mara, which are trading at half their peaks from February. And potentially after the halving is done, and prices of crypto keeps climbing, these miners could start climbing as well, regaining some of their lost momentum. So with that, thank you.